So if you guys remember from the economics onboarding class that we did, Japan is pretty big because we borrow a lot of money from Japan when our interest rates were high. And you can see here, we talked about monetary policy. Monetary policy has to do with inflation, right? So that means Japan is going to adjust their inflation. So that meeting is going to be very important because if they do adjust it and the inflation increases higher, it could motivate people to start selling things off in order to pay off loans in Japan because of the interest rates. So that affects money a lot. If Japan keeps it the same, then we should be clear, everything should be fine, and we can see new all-time highs. I doubt Japan is going to reduce interest rates because they're already at the lowest regardless, and their currency actually took a very big hit. So if we go and check out their currency real quick, for those of you who've never seen it, it's USD JPY. That's the conversion between us. And if we look at their currency on the weekly time frame, or matter of fact, monthly time frame, you'll see that they are at prices that they haven't seen since like the 1900s. So if we look at this full chart here, you'll see this high right here is from 1986. And this is where they are right here, right now. They haven't only been this high on multiple occasions, right? They have here from 1990s, they have 98s, but they have not been to these levels since until we got into 2022 and then here to 2024. So all of this is pushing Japan into an area that it has never been in the 21st century. So if we do go above this, then that's going to be scary. So you can see why Japan would be motivated to change their interest rates to help their currency go back to the norm, right? So if they can get their currency back down to at least a 120, I'm sure that would be their goal because that seems to be fair value here, then that could potentially affect the American markets, right? So if that makes sense, they're more than likely motivated tomorrow to adjust their interest rates. So if they do increase them, we can expect to see a reaction on the live markets for NQ. So we'll be looking out for that. Market open already? Okay, nice. And back here, turn these things back on. So does that make sense, right? Why Japan is in their issue? I don't know if you guys been following that at all, but if not, you learn something new every day, especially in here. So this is what we're going to be on. But we'll keep walking through these economics, but that's the big one that's in the way right now. So everything that you learn here, right, we want to take it day by day. This isn't something you want to just get on the markets and be like, oh, let me check Japan's currency. It only matters when it matters. So you can see here, this is Thursday to Friday, Japan's talking. We got 11 a.m. Thursday, which I don't know what time this is. I think it's EST. So that would be today. And then we'll see the Friday news as well for their press conference. So it should be very interesting Friday. And then at 11, I think we'll probably see some action as well here today. We've already had this 3-shot, and then this is the liquidity level for the nuke, and the nuke has already ran the liquidity lows. There's a few here, and we've only made it to this one. So the market can dump, grab things, and then try to come back up again. So we'll see how it's treated. You can see the market open, took advantage of the lack in sell pressure and pushed a bit higher than these highs currently. So that means technically if we break 21,905 with a full candle close, we can start shorting it. Otherwise, everything is just a reach to scare people and then a reach to the low to scare people. And then we never really leave the zone. We'll go to the smaller time frame for a moment until we get out of this range. But the way it's looking right now, we have this liquidity low. That's the nuke play. So if we do not go lower, then we will push higher. And we do have all 3 highs here. So if we end up coming down to 21,905, that's the only reason to short. Everything else should be pushing us above the 78 level on the 1 minute here. That should already blasting off. Motherfucker, bro. That's crazy. I should have lagged at the fucking perfect time. How dare you? All right, well, we got the break above the 78, so that's parabolic. Like we said, this is a nuke play that failed to work. If one thing fails, the other thing can succeed. So we see the opportunity prior to was already taken away. Then you can see the liquidation here. And they pushed above that 78. That's pretty fire. And we got the trend line here still being held. So pretty decent takeoff. So now we just need to collect data. This is the area that gets a lot of traders because it's not doing a breakout towards the upside or the downside. So this is why I do a lot of mental positions to try to get my brain understanding that price is doing the opposite of what I'm doing. So if I believe it to sell off right now, meaning to start breaking out and start running, if we don't actually see confirmations of doing that, we might just see a buy order come all the way down again to 958. But so far it failed these two buy orders and we closed higher prices, but not higher than this. And we're not getting back above our trend line here. So if we were averaging into shorts here, we would have averaged here once, here twice, and now it's testing us again to see if we actually want to hold those. And in order to stop us out of those shorts, it would potentially have to come past the wick here for the buy side. But if it gets there, then the buys could potentially take off. So there's a good chance that they just keep the middle of the box average. And if they keep that box, then we can actually see a break above and then get 919. So still waiting on confirmations. Let me take a look at the inverse again. Yeah, so we went down to the retracement level once, twice, 3 times. So it's looking good for the buy side on this version. And then on the invert scale, like we said, if they want to stop us out of our sell position, they need to push us all the way back to this order block, but it's already been swept. So there's a potential breakout that will happen from here straight to here, and then they'll play games and then continue the rest of it. So not my favorite setup because as we've seen before, if we buy the breakout, they just wick it all the way back up again, and that could be a fat loss for no reason. Cool. So I'll be more confident on the sell side if we get back above this black line. So with the mental buy idea, we failed once, twice. This is a third time. So this could have been our opportunity to just hurry up, hop into sells. So here's our full level on the sell side. So I'll probably start looking to average into real shorts this time and see if we can break. Otherwise, they're just going to keep playing this wiggling game until they break a level and then bust out of here with the buy side. So I'll try the sell side break here, just one contract. This could completely flip to the buy side if it wants to. So in order to be really confident, we need candles to close above 950. If we don't get candles closing above there, we don't want to average in. We'll have to take whatever small loss we get on the buy side. If we get stopped out of the play, there's a good chance that they're just playing games until the buy side is ready to go. Again, I'd like the candles to close above the black line in order to really get this play going. Otherwise, we just keep tapping, wick, and then run straight down for the stop losses. So make sure you manage your position because it will come to stop us out at 968 if we're not going lower. You can see the box here and how it's being held, the bottom of the box. All right, broke above it once, touched twice, touched 3 times. So eventually, if we don't get it back above this midpoint, we're going to have to give up the sell side and it's going to push straight back down for the buy side again. And we'll get this inching game, which makes us lack conviction a lot. And then on the 1 minute, we're also looking the same, right? We have the buy that broke. We have this turnaround point. And eventually, if we can't get the sell side to happen, these buys are just going to rocket straight past. So we got stopped out of the sell side. They had opportunities to sell it off and didn't. So it looks like buyers are back on the map. If we don't get these breakouts now, then we're just ranging. They're not going to give us the dubs. So remember, every time we buy down here, they do a big wick to stop us out. So that means we'll be in a full range. So there's our first break there. So now that we have our first break, I'm going to take the original size of the first wave, and we're going to open this on the second wave, and our price target, first price target, we're already there. And then our second price target will be here. So ideally, we just don't want to get stopped out before we get to the last price target. So if we do retrace back, we don't want to get back above the 78, which is up here. And our position is really close to the discounted area. Notice after a big run, we get this whole arching motion. So you can see this counts as a big run. And then here, we'll probably see the retracement to the 50 and 60s before we actually get a turnaround and come back down. There's a nice break, retrace to this discount area. We want candles to close under this price target, or they'll reach right back up for our position. If we were to take a trend line through that whole thing, it looks like this. So it looks like this candle closed aggressively on the line, and then this one's running away aggressively as well. We don't want candles closing up because that could be a potential reversal, meaning we are losing momentum. We had a few averaging positions here, but it doesn't really put us in a pretty picture. So I'll just take the original position we had. But as you can see, we retested the level here. We also seen this aggressive push here, which were both averaging sizes. But since we don't have any profit on the day, I'm not going to average into a play that's going into levels that we can't see. So that's risk management for you. I'm going for stops at 988 flat. And then we're looking for the full move down to the lower end of the box. Technically, right now, we're pushing into the halfway point of this deviation, right? This part of the box. So we should experience some levels here. If we can get a full flush, that'd be sick because that means we're going parabolic. If we don't, then this is going to base again, and then it can try to come up again. This is like a $6,000 play right now with 10 contracts. I'm going to set my take profit there initially. So that'll be a full $1,000 play. That's like a 10K trade with 10 contracts there. So what we just did was a concept of Elliott's wave, right? Which we talked about in the course. The first wave was identified at the open of the market. So you'll see one like this. If this is all we're introduced to, we see one wave. Wave 2 came down, reached twice. So then wave 3 has to be bigger than wave 4, right? So that's why we use the box. So the box of 1, this shows us the price of 1. So if we put this box on wherever the 2 started, which was here, right? The 2 started at the bottom, but then you can see with this reach back. So that gives us the trajectory of the 1. So remember, the 3 has to be bigger than the 1. So if the 1 moved here to here, then that means the 3 just needs to go past the point of the 1, which it already did. After that, we can't guarantee just how high this can go. But we do know that if this is wave 1, 2, and 3, that we're not allowed to close below wave 1. So if wave 1 took place and wave 2 came back and wave 3 is currently running, wherever 4 is going to be, it cannot reach below the 1 with a candle close. So eventually we will get the pullback of this initial run here, and that will be 4, and then we can expect our 5th wave. So that's top and bottom here. Wherever we get that new high. In order to confirm a new high, we need to close a new lower low or higher low. So you can see this is a low here. We need a candle to close under that. There is a low here. We need a candle to close under that. Once those two are confirmed, that means wave 3 is over and we can start looking for wave 4. So something I want to point out here is we describe this as a base run. Right, so let me change this to black. So a base run, right? So you'll see a run, and then the base is when you have price moving in this kind of pattern, which creates a base, and then you'll get another run, and then you'll see another base opportunity, and then you'll see another run, right? And all of this usually just is like a curve pattern, right? So eventually, one of these are going to grab above the highs of the previous, and then you'll get that run. There goes that fourth candle right here, right? So the three was over immediately when we got out, which is fire as fuck. So now we're getting that fourth pullback. You can see here on the current price, right? We have the drop, and then look at this base, right? Because here's the high. It never got the high. That's why it couldn't move with intention. So you get this phasing candle experience. But when you do get the high, you can move with intention. So if we look at the highs here, here's a high. Look at the way it grabbed. It actually grabbed above those candles versus the way it articulated here. So it was protected, right? So when it grabs at the level, it has no liquidity. So it moves in a very ugly manner, which was hard for us to average into. But when it actually grabbed and started running, that was valid, right? So that actually gave us direction to be convicted in. And then we have another run, right? Another base of the candles. This actually grabbed above those highs, like we said. Another run, base of the candles, run. And then here's a base, but look at that base, right? Completely blast off. So in order for that to fix itself, we'll have to go through a whole nother experience of what we just literally watched in real time, which is this, right? That's a lot of price action. And there's a good chance that that would have to do the same thing all over again. So oftentimes I get chopped up in this area because it's giving me a lot of different signals all the time. It's like, yo, this is buys, this is sells. So if you watch, I was back testing this morning and I recorded it. And at the end of the back testing session, we pushed into an area very similar to this. And I lost like maybe 4 trades back to back in this area. And that's because there's just not a lot of conviction. So the best thing I can say in the fourth phase is just wait for real confirmation. But oftentimes real confirmation is presented and then disregarded in the next candle. So it's a very difficult area. I tend to avoid trading in the fourth phase of the Elliott wave if I don't have profit. If I do have profit, then obviously I'm okay with taking a bit of the risk on. So for right now, we are in that fourth phase experience. So I'd like to sit around to watch it. And if we see a valid trade, I'm down to take it. So here's the top of the third wave, right? And here's the lowest point of the third wave, or sorry, the second low. And that looks really nice. If we look at the levels, right? Touches here, touches there, candle bodies are closing there. It's messing with the 78 there, retested the 78. So yeah, nice Fibonacci. Let's even if we don't actually trade this, I'm down to watch it if you guys are. Cool. So something that we also do, right, when we trade the fib is we watch this area very heavily and try to make decisions immediately. So we have a touch of the fair value and we're interacting with the 78. If we go to consumer psychology, right, we know the lowest price, we know the highest price, and we know the fair valued price. So as candles close, we get to actually see what consumers are accepting. So if we close lower prices and reach for discounts and see very strong buy opportunities, then we know that this asset is still uptrending, which means that these areas can be bought, expecting when we get back to the higher premiums that we should see a higher price. If we don't touch discounts, right? If we don't touch any of the discounted areas, but we did touch the fair value area and we keep failing the premium area, then this would put us in a range and then eventually create a declining asset because it shows a lot of uncertainty at higher prices. So right now we do have a pattern on our table. It looks something like this. And if you look at the cheat sheet, right, we usually have one bottom, two bottoms, and then it closes, and then we buy the breakout, and then we'll see it blast off. And we did technically get a fair value touch of the fourth wave, and it also follows the rules, right? Like we said, it can't go back below the one, and check it out, just before the one itself, right? So technically all of this needs to create the fifth wave for confirmations, right? And then after that, we'll get into the corrections. So we got a little bit of money on the day, about $1,000. So maybe you can risk 200 bucks. Not sure how far $200 is, but I'd imagine if we bought here, 200 bucks is like only down to these wicks. So I'm not down to buy this breakout. Fortunately, it could potentially run, but I'm okay. I'd like a better price on this. Somewhere in here would be ideal. There's no rule about the 5 being any bigger than any of the other levels. Ideally, it's usually smaller than the 3. So a rule of thumb that I like to do is take the price of the 3, and then I'll throw a box on it, and then usually my target will be the midpoint. And you can see it's kind of struggling with that midpoint right now. So technically that could be the fifth wave already done because it doesn't have to be as big as the third wave. So we'll see how it's treated. If we do actually get back above the levels, then cool. Down to run it for the full wave there. And then we can also take it to the deviation, right? And by deviation, we mean, you see this rectangle? It has one box in it, and then it has another box. There's 2 different boxes in there. Those boxes are referred to as deviations when we talk in a financial term. So that one box is a deviation. So if you put another one of these boxes inside, you'll see you can split it up into a fractional share, right? So it's just cutting it into smaller pieces. So you can see that one deviation is also broken up of 2 more. And then if you continue that, it goes on infinitely, right? You'll have a deviation and a deviation. If you need multiple targets in there, just add another layer on it. And at least that gives you price target, right? So you have price target 1, 2, and 3. And there'll be proper price targets that usually align with psychological levels. So you'll see this line here literally aligns with 22,050. If we can get a buy order on 025, I'm down. There's a good chance it might get slapped out. If it closes up here and then just plummets down, then we're just going to have to cut it, unfortunately. But we don't want it to go lower than the intersecting trend line and the white level there. And if not, it's just going to take off. And that shit went a little quick. Be careful. It's coming back down here. If it fills us, it might just come back to slap us straight out. So I'm going to put my stops at 19 here. Can we get candles to close up there? Otherwise, we risk the 200 bucks. It could still wick and grab 0.25 to go for a run if it really wants to play games. So we need a new close of a high right now. It's got to close up above 36. Okay, so we can move our stops to break even at this point and then let the play be free from here. Mm-hmm. Yeah, if not, it was coming down for that 19. You can always get back into the play when it looks valid. So it's better to just cut it rather than holding something that potentially is about to switch up on you. So like we talked about earlier, right? You get the run, the base, right? Grabs the highs, get another run, hit the base, grabs the highs, get another run, right? Here, grab the highs again. Here's another run. This is technically the base. So then this grabs only these highs and then comes back down for another run. Otherwise, this is about to switch up because look how flat this is right now. It's very flat. And it's the same area basically as the first couple touches. So the 1, 2, 3 works really well because of consumer psychology. Right? So we have a 1 there that's pretty prominent, a 2 there that's pretty prominent. So that 3 could be short-lived. And then we might see like a range be created out of this market. So that means no more trending momentum. So this is now the nuke play. This is sells, and then this should blast to new prices. This is where you usually put sell orders, and then you want to see it grabbed low prices here. Try one. If we get wicked back above this candle, I'm out of here. 5 stops are on. This is the opportunity for the market to sell off. If it doesn't take it, then we're not done. The wave will potentially go higher. You can see the way it's fighting to go down. So this is the base. This is the high. It just grabbed the high and it actually closed low once more. So that might actually be the go ahead. So I'll put my orders here. Okay, well, there it is now. And then here is target 1, and then new price is target 2. And then if it wanted to be very aggressive, it can go all the way down for a new low. And that new low is pretty steep. But we're very bullish. If we don't close any candles at a new low, then that sweep will just come back up and take these liquidities. I like it. I see the base in this area here. See this? So we just don't want candles closing higher prices. And then if they do, then we just got to get out. But the problem is they love testing the wicks. So they'll push price really high, grab, and then dwindle off again. It gets scary. So, all right, cool. Now we can put stops at break even, and we should be golden. Oh, there's price target 2, and here's price target 3. That's a low. That could come up and grab our stops. Otherwise, we should see 21.99. There's a new play. Should be. Oh, there's an imbalance right here. Sheesh. That's a full recovery. Damn. Yeah, they're not ready to sell that off. Nice target stuff. I'll just leave the stops there. That imbalance got us for sure. I hate that shit. You can see it right here. That's one imbalance they used to bring it up. And then here's another imbalance right there. That reaction was so fast that anybody who didn't see it there would have got slapped. But not bad. At least you got to see the nuke play in action. And that imbalance is crazy. All right, so now there's 3 tops up here. Sorry if this is a bit confusing, but there's a lot of shit the market's using right now. So now if it closes above, then it can get those highs. Otherwise, we'll be using all this to just keep going lower. It's just there's a lot of like mines in the way, right? So an imbalance was left by the buyers. So if you think about, I don't know, think about any game, competitive game, right? If you're, let's say, Call of Duty camping in a building, there's a back door behind you. You're going to leave a bomb there just in case someone comes in there. So as you continue to run, if they ever make it back there, they hit it, right? And when they hit it, you get 1 kill. It might not change the whole game, but it changes the moment, right? So you can see here that it definitely did change the moment. But this reaction is pretty aggressive back to the downside. Did you guys touch that nuke play, or did it happen a bit too fast? That's the one we talk about in the course all the time. That shit is fire. One of my favorite plays because it moves so fast. I'll do a quick one for it, right? So you can see the 3 tops here. You can see liquidity's been taken here, here, and here. So the next time you get to this level, just sells off completely. So the first entry that I wanted to get was here because I thought this one was going to do the run. Then it came up and grabbed us, and then we got right back into the play, and then that took us down. And then the targets, we had 1 target. Here was the last target, which I really wanted, but those imbalances do very good things. So it looks like we're about to get that last target right now. But not a problem. Risk has been managed the whole time. Every trade has at least been recovered, which is sick. Cool. I'm not mad at the execution at all. A lot of real-time stuff. Trading's not about actually winning, bro. It's about keeping the money you make. You know what I mean? Or not losing the money you have. So although the trade works out fine, that's good. That's dandy. It helps the brain for the next time. But the main mission of the day is to keep the money you made, you know, manage the risk properly. there's always going to be a very crystal clear setup eventually. So there's no point of just trying to take what you see on the screen at full fledged force if you don't actually have the profit to take it, right? If you want to add a lot of money into it, unless you got that much experience and conviction in the market and the way that it's been moving, send it. You know what I mean? I slap on 10 contracts immediately on plays that actually go my way. You can see today is a bit tricky. All the plays are a bit slow. So it's not my favorite type of market. So it's risk off, but it is good practice. So with one contract, you can still make decent gains, but you also get to add data theory to your brain. So there's a course, CBLMD, where we talk about the psychology of trading and we talk about the New York session, right? The 936 consumer psychology. We talk about two models, right? The two models are like, what strategies are you trading? So right here we have the nuke play, right? And then we had the Elliott wave experience that was taking place. So those are the two models. And what was our conditions today, right? Our conditions was the Elliott wave. Knowing that we're in the waves put us in a bias of saying, okay, well, eventually one wave has to reach back and run. Second wave has to reach back and run. And then after the waves are done, we get into the correction phase, right? And right now we are in the correction phase. The Elliott wave is over, right? So you can see we got wave one, wave two, wave three, four, never went past the one, and then five gave us the high. After that, it's all ABC from here, right? So we don't know where this market could potentially going. It's going to need to do a new correction. So this is usually where a lot of traders get caught up in. But we just saw one of our plays, right? The nuke play, which was nice, but then we got this garbage that took place and brought it right back up on us. But nonetheless, really valid. So now, knowing that this wave is over, there's a good chance that this market is going to stay stagnant for a bit. And that range might look like this. And you can see that lines up so perfectly, right? You have the lowest wick here, and then you can see there's a level that's been tapped, right? And it's been playing on that one. And then we do have highs here. So although you might see direction in these areas, understand that there's no trend because there is no new wave to be used, right? So until you get a new wave, a new impulse where you can actually throw a fib on it, you're not going to get direction. So you need to take profit when you see the targets touch, right? Had we had figured that the waves were finished, would have been ideal to take our targets rather than looking for full price targets, right? So right now you can see just how it did get to full price target, but it did a lot of garbage on the way. I completely despise those kinds of trading markets because they test your patience a lot. They make me feel like a bad trader, right? So imagine someone who's trying to learn. You feel like you don't even understand what the hell's going on. It's because you're trading in the correction phase and not trading with the actual momentums and trends.